Well, hello, YTPC. This is Dave coming to you from the paddock here in Southern Maryland. It's Thursday, the last day of February. It's leap day as well. And we're going to get back into our investment series. But first, I'm back with the Marks Maryland Meerschaum. And look, I'm getting a little bit of color in the bottom. Pretty cool. What's in it today? And this is one of my rising star favorites, McBaron's Old Dark Fired Ready Rub. That's the laziness in me. I've got ODF in the jars, but I've got it already rubbed. So the lazy man in me wins quite a bit. So I want the Ready Rub. So quite a ways through it, but it sure does taste good. I'm already 80% through this bowl probably. Thank you, Greg. All right, today we are here. That's ETF. So today is ETF. I think that will be the only subject for the investment series today is ETFs, exchange traded funds. You'll notice we have crossed over from the green, relatively low risk, into our first yellow, our first medium risk. Remember what medium risk means? It means you don't control what happens. You don't know what you're buying performance wise. So what I call, these are market driven returns. And you or I have absolutely no control over what happens to your money now that you've put it into an investment account and then purchased shares in an ETF. That's why it's, in my opinion, medium risk. So ETFs are the easiest, simplest, probably lowest risk way to put money into a higher performing asset and take advantage of the stock market without having to go to individual stocks. So why do people go to ETFs? I'm going to show you. So I'm going to turn you over. Let's go take a look on the screen. I'll show you why people do this. So one of the most common ETFs is the S&P 500 ETFs. There's 100 of them out there. Normally they're SPX. That's the symbol you'll often see associated with the S&P 500 ETF. And here's why. You can see pretty much year to date, we're only 2 months in, it's already up 6.4%. Sorry for the weirdness of the screen. And for the last year, it's up 27.5%. So you can see it's 5 times the value of those fixed price, low risk items. You know, your CDs running 5%, and your U.S. savings bonds, U.S. Treasury notes, U.S. Treasury bonds, you know, that are running in the from 2 to 5% range. And then you see this one that's like 25, 26%. So that's been a good year in the stock market for the last 12 months, actually more than that, but it doesn't always go that well. So there are down years as well. So I just want to show you one ETF for the last 12 months, 25, 26%. So that's why. So ETFs gives you the chance to play a wide number of stocks and model a wide variety of stocks and not have to take the much larger risk of trying to pick the right stock. So they're built as an index, and that index is built to mirror whatever index of stocks it is built upon. Like I said, the most popular one, the one that most people hear about the most, is the S&P 500, Standard & Poor's Top 500 Stocks. They're also out there for the NASDAQ. The NASDAQ has 3,000 stocks in it, so you can buy a NASDAQ ETF, which tries to mirror all 3,000 stocks. You can buy a NASDAQ 100, which models only the top 100 stocks in the NASDAQ index. Those are usually called the Qs. QQQ is the symbol. So SPX is the S&P 500, as we saw on the screen, also called spiders. You can also get one for the Dow Jones. That's 30 stocks. That's the one that, if you watch business channels or business shows at all, they always talk about the Dow Jones or the Dow Jones Industrial, the DJI. And that's only 30 stocks, but there are ETFs that model the performance of all 30 inside the Dow Jones. If the Dow Jones kicks out a company and adds a new one, the ETF automatically models that change. So you have to decide how wide you want to mirror, because you can go really wide. There's also the Russell. The Russell stock index is much wider. You can get 2,000, you can get the Russell 2,000, the Russell 3,000, and the Russell 5,000. So that's truly the market being modeled in one place versus these 30 for the Dow, 100 for NASDAQ 100, and S&P for 500. You can go much larger and buy the Russell. So that's something that you have to think about, is if you do want to move into this medium risk category, you will have to decide, what do you want to be modeled? What do you want to buy into? So how do you decide that? That is up to you. That's where, I'm going to kind of stop. A couple of you said, hey, I like the fact that you give us information, but then you make us think and do some of this on your own. And that's exactly what I'm doing. I can't spoon feed this all to you. You have to take on some of this. You can go on the internet and just do your own education on, why S&P versus why NASDAQ versus the NASDAQ 100 versus the Russell. Why would you choose those? That is really your call. Just know that you're taking on risk. It's not a guaranteed return. In fact, there's no guaranteed component of it. So if the S&P goes down 10 or 20%, which some say it's going to, some say it's going to go down 30 and 50% in the next couple of years. Some say the economy is headed for a real crash, and we are looking at 60 or 70% reduction in the market indices. I don't know which is true. You have to decide, is the economy at a peak and getting ready to trail off? Is the economy at a peak and ready to go higher? That's what makes it a market. Some believe it's going to head down and some believe it's going to head up. That's, if you go in and buy the S&P 500 spider index today, someone's selling that share so that you can buy it. And that's what makes the market. Somebody says, I'm done with this, and they're going to put their share in the market and you're going to buy it. Or conversely, you think you've lost enough money in it and you want to get out, someone's willing to buy it at that point. Or you've made enough money and you're willing to get out, and somebody's willing to buy it. There's always someone with the opposite opinion of you. Otherwise, you wouldn't be able to buy or sell shares. That does happen, by the way. And some of these other vehicles, you can get what's called market limit up, market limit down, where the market stops and will not allow trading to occur. That does happen. We do have market triggers set up in the United States. If the stock market were to go down, I don't know if they have upward bound targets or not, but certainly if it's gone down enough, it will trigger a index stop, and the market will stop trading until it's either come back off its mark, or for a certain amount of time, several hours, or even for the rest of the day. All right, here's some graphs on how the S&P is done by year since it was created, I think, in 1927. Blue is positive, red is negative, obviously. But You can see there are a lot more blue years than there are red years. So that tells you that if you have the timeline, which goes to that runway discussion and your age and how long can you leave your money in, this is why people do it. Because it's considered a fairly low side on the medium risk scale. And then you can even come down here and it will tell you every year. Currently it's right here, it's 6.5% this year. Last year is 26%. The year before it lost 18%. The year before that was 28%. Then 18%, 31%, and then 18 was another down year, -4%. The year before that was 21%. So you can see if you hold it over 5 years, let's say your lifespan, your runway, you can leave the money in for say 3 years or for 5 years or for 10 years out in front of you, the odds are in your favor if the S&P 500 performs like it has in the past. Now you'll hear on every investment ad will say past performance is not indicative of future performance. So, and this is why they say that, because this is what it's done for 100 years, but that does not mean that's what it will do this year or the next 5 years. And that's where the risk comes in. But you can see using past performance analysis that there's a lot more up years than down years. And you can see the 3, 5, 10-year average is actually pretty good. But again, that does not say the next 3, 5, 10 years are going to be good. It's just showing you that the historical analysis tells you it's a fairly low risk once you get into the medium scale of risk for your money. So how do you choose? Let's say you've decided, I want to do this. All right. I want to get into this stock market thing. I want to buy some S&P 500 index funds or ETF. How do you do that? Which one do you buy? There's 1,000 of them out there. So there's a couple of companies that will help you compare risk levels and then fees. ETFs, I believe, have the lowest fees I've ever seen. They're in the 0.0 something percentage. But the two companies that will help you, one is Morningstar. They're probably, if you go to morningstar.com, they have a whole bunch of comparisons, a whole bunch of analyses. They're sort of the industry standard recognized name on fund comparison, investment risk, stuff like that. They'll actually give you, last month, last quarter, last year, last 5-year performance ratios. So you can see how each of these funds have performed, what their fee structures are, so you know which one you may want to buy. So Morningstar is probably the one I would go to first. The other one that I used to follow that I don't follow as much anymore is the Motley Fool, Motley, the Motley Fool. Another kind of funny. I mean, they have a sense of humor at times. But that's another one that they'll go and you can talk about. That's an educational site that will teach you strategies and show comparisons as well. So Morningstar and the Motley Fool. And here's the actual Morningstar ETF screener. You can see it starts the list here. And then it tells you how to do it. Click here, go to the research tab, select ETFs. This is a really good tool. And then here's the Motley Fool's page on how to choose the best ETF that you want to get onto. All right, guys, we need to talk about market timing. So let's say you've made the decision. I've got some money. I've got cash in the mattress. I've got some CDs, maybe even got some savings bonds or some U.S. Treasury notes or Treasury bonds. So you've got some cash, you've got some fixed returns out there, but you still have some money. Now what, right? And maybe it's the same amount of money, and you used it to get your cash settled, and then you move that to getting some fixed income, and now you got that same money, and you want to move it into these more medium risks. So you've made the decision, hey, I'm going to do an ETF. And you've done your research on Morningstar and Motley Fool, and you've decided I want to buy the S&P 500 ETF, and you found one that you like. Now what, right? And so you have to decide, are you going to buy in now? Are you going to buy all in now? Are you going to put everything, all the cash that you have into this? Or are you going to invest in it over time? And so the concept here you need to understand is that people suck at market timing. All right, what I mean, like right now, the S&P 500 is at an all-time high. There's philosophy that says that is the worst time to buy into it. And there's a philosophy that says that is the best time to buy into it, right? That's why investing is so weird and complicated and makes no sense. Because you're always going to be able to find the argument. So I am going to say that the tried and true way to invest at this level is dollar cost averaging, which is such a buzzword, right? But I'm trying to decode lingo for you. Dollar cost averaging means you put the same amount of money in every X for as long as you want. And what I mean by that is every Friday you dump $100 into it, or the first of every month you put $1,000 in, or whatever your number is. You close your eyes and do it. What you don't do is say, well, the market's as high as it's ever going to be, so I'm going to hold my cash and wait until the market crashes before I put my money in. And then you watch it go higher and higher and higher, going, oh, what the hell was I thinking, right? Or you think, oh, hey, the market's off the last few weeks. I'm going to put my money in now only to watch it continue to go down. Because you don't know shit about whether the market's going to go up or down. Do you know why you don't know shit about why the market's going to go up or down? And the answer is because nobody knows, all right? Nobody knows if the S&P 500 is going to be higher on April 1st than on March 1st. Not even the big names, not even the market makers. They just don't know. The market forces that cause pricing to occur is not understandable by anyone that I am aware of after doing this for 20 or 30 years. And I have some of the best advisors in the world as friends. You just don't know. So how do you take advantage of that? You dollar cost average, right? So if you have $10,000 to put in, don't put $10,000 in tomorrow. Put $500 every other Friday until you've invested your $10,000. Something along that line, okay? Dollar cost average in is the buzzword or the buzz phrase you will hear. Don't know what else to say about that. But Dave, I don't know shit about the world economy. How am I supposed to know what's going on in the larger environment around me? Guess what? Neither do I. So you have to find people you can read and study and follow and get smarter as the months and years go by. I'm going to give you the one I read. I read a fairly young woman who's an analyst on world and U.S. economies. Her name is Lynn Alden, Lynalden. Lynn Alden. We're going to go look at her in a minute. She has a free area and she does pretty good analysis there. And she's got a paid service. It's $400 a year or something like that. I bought her paid service and I read her paid weekly. Now she has a free report that she sends out and it's pretty damn good. And if you choose to, you can invest some money. You get a weekly. Every Sunday night, she sends out a paid premium report. She also has model portfolios, and I'm pretty sure she shows them in her free service. We're going to go look. We're going to turn around and look without logging in and I'll show you what she has. But she's a tough read, man. This is a smart chick, and she does real deep research on individual stocks, and she'll tell you what she's doing, and she'll show you when she makes changes to her model portfolio. You can't be having a conversation and trying to read a report. You can't be trying to do something else. For me, I have to sit and study what she writes. And I consider her pretty damn good, but you got to really want to get through the material. All right, here's Lynn Alden's landing page, her home page. So there she is. She's land on her home page, and she's already got some pretty cool stuff on the top. I've not bought her book yet. I can't do much from here because she wants you to register before you start seeing the letter. So I'm going to go ahead and log in and show you a couple of her reports. Okay, guys, I'm logged in, which means I'm in the premium area. But the reason I'm doing this to you is down here at the bottom, these are all premium reports. But here's the latest issue of her public newsletter. Okay, so if you click here, this is a report you get for free. You don't have to join her to get this. And this is all her thoughts and analysis. I mean, I can't tell you how educated you would be if you just did her free service. Here are the individual analyses. And hang on, you gotta just hang with me. This is all part of her free report, guys. She does, I believe this is every 6 weeks. You can go on here right now. All right, portfolio updates. You see right here, I have several investment accounts and I provide updates on my asset allocation and investment selections for some of the portfolios in each newsletter every 6 weeks. All right, premium, she gives 3 more. All right, but this is in her free service. She tells you how it's allocated, and then she actually shows you the categories that she's in, and then she shows you the individual investments that break up those things. If you want someone who's way smarter than me and actually follow her investments, you can do it. All right, enough of that. Lynn Alden does not know who I am. Even if you bought her premium service, she would know it came from me. I get nothing from any of these. Morningstar, Motley Fool, Lynn Alden. I have no idea who I am. I'm only saying these things to you because they are what I use. So I have no affiliation with anything I talk about here. So guys, there are ETFs for every class of things you'd want to buy. There are, so all those U.S. Treasury items we talked about yesterday, you can buy an ETF for those as well. And they'll put a mix of the 1 month and 30 year and 10 year. They'll mix them all up for you and you can just buy the ETF. All right. There is an ETF for anything you want to purchase. There's an ETF on FANG stocks. What are FANG stocks? Where is that on our? That's individual stocks are our first red one a couple days from now. We'll talk about FANG stocks later, but just know that there's an ETF for FANG stocks. There's ETFs. There's thousands of ETFs to choose from. All right. I'm telling you, the simplest one is the S&P 500. It's the most popular, and it models a stock portfolio that's pretty wide. So I think that's why so many people use it. Because I don't know your level of interest. Do you want to spend time getting smart on this or not? A lot of people say they do, but they aren't going to read, right? Because I've given you 3 sources, Lynn Alden, Morningstar, and Motley Fool. You could become a freaking genius on those 3. But will you? Will you take the time to go over there, create accounts, read newsletters, read research reports. It's up to you. Participate in your own survival, right? Don't be lazy about your money, or your money will be lazy for you. Okay? So I think that's it. I'm going to go ahead and put us all together and check out how long it is. I'll come right back. That ODF Ready Rub tastes fantastic. Guys, we're at 25 minutes. We're going to kill it and be done. This is big boy stuff, okay? If I can do it, you can do it. There's nothing special about me. I'm just willing to read. I'm willing to work for my money so my money will work for me. I want that for you. But I can't want it more for you than you want it for you. To say we've barely scratched the surface on the subject of ETFs would be the understatement of the century. %99 of people will not go beyond what I've presented here in the world. Not just you, but in the world. You just have to decide if you're willing to take the time to start doing some research and some reading and get smart on this. Some people say, I just want to dump my money and let someone else manage it. And you will pay the price for that decision. I'm not saying it's a bad decision. You will just pay that service, that person, a pretty good fee. Sometimes it cuts your returns in half or more if you just take the lazy approach of dump and run. It's not an entirely horrible option if you're not going to take the time to get smart. Ouch. I know it doesn't sound very good. I say it and it doesn't sound good. I can't imagine what it's like to hear that. You have to decide what kind of person you are and how hard you're going to work so you know your money's in the best place it could be. The other thing I'll warn you about is do not skip the lower sections, the less risky sections, and just jump to this one. And my God, do not skip all of them and go out and do what you see me doing on these screens, which is day trade futures, which is out like 5-6 days from now. I will tell you about it. I will tell you what I do and how I do it. But if you think you're going to run all the way out to there and put a bunch of your money out there and get a whole bunch of huge returns and use those returns and then go back down the risk scale with that money and use it, I'm going to tell you, I think that's a fool's errand. I think that's folly. Guys, don't email me and say, which ETF should you use? I'm not going to answer those questions. How much of your portfolio should go into ETFs? I'm not going to answer that. That requires a relationship that you and I will never have to provide me enough information to answer these kind of questions for you. If you want help at that level, you have to go to a fee-only advisor, someone who you pay an hourly rate to, who will get to know you well enough to recommend a strategy, an allocation, and an entry. Okay? So that's what we have to do. We have to decide what mix of these things works for you, what product you're going to enter at each level, and then you have to discuss the entry points and how to fund that strategy. Guys, that's it. I'm going to shut up. I'm going to assemble this and get it up for you. And if you have questions, if this is landing for you, if this is helping you, let me know. If you have questions on this material, ask them. The feedback's been pretty good so far. And that's it. It is Thursday. Tomorrow's Freedom Friday. We will be participating in Freedom Friday tomorrow. I have something special, at least in my heart, for tomorrow. I hope you're having a good Thursday. I hope you're having a good week. Hope you got plans for your weekend coming up. Talk to you tomorrow, guys. Bye, everybody.